Why India's wealthy are choosing Bitcoin over gold. The affluent in India are increasingly trading their gold for Bitcoin. Here's the scoop. In recent times, a growing number of wealthy individuals in India are reallocating portions of their gold-based assets into the glimmering realm of digital currencies, particularly Bitcoin. The primary attraction of Bitcoin today lies in the surge of institutional interest and the establishment of clearer regulations. For generations, gold has been regarded as the ultimate symbol of wealth among Indian families. From treasured family heirlooms to wedding gifts, gold has represented trust, security, and cultural significance. However, the landscape is shifting, and so too are the strategies employed by the wealthy to manage their assets. Currently, a subtle yet significant transformation is underway. An increasing number of India's elite are diverting parts of their gold-backed wealth into modern digital currencies like Bitcoin. What's spurring this change? What is driving this transition from the traditional yellow metal to a digital asset that was virtually non-existent just 20 years ago? Edul Patel, the CEO and co-founder of Mudrex, states, since the U.S. elections last year, there has been a global uptick in interest towards cryptocurrencies, which has bolstered overall confidence. In India, a growing number of high-net-worth individuals, HNIs, and family offices are beginning to incorporate cryptocurrencies into their investment portfolios, primarily for diversification and as a protective measure. At Mudrex, approximately 30% of our trading volume now originates from this demographic. Typically, they allocate about 2 to 5% of their investments to digital assets such as Bitcoin, Ethereum, and Solana, with these three cryptocurrencies alone accounting for nearly 70% of their total investments, he elaborated. Bitcoin's increasing attraction. What sets Bitcoin apart? Its most compelling feature today is the growing institutional interest and the establishment of clearer regulations. As the cryptocurrency market evolves, Bitcoin's notorious price volatility is gradually stabilizing, making it a more appealing option for long-term investment. Sumit Gupta, co-founder of CoinDCX, notes, the perspective among wealthy Indian investors is shifting from questioning the rationale behind investing in cryptocurrencies to contemplating how much they should allocate to it within a well-rounded investment portfolio. He emphasizes that trust is on the rise, thanks to major global players like BlackRock introducing Bitcoin ETFs. Such initiatives send a powerful message that Bitcoin is no longer just a niche interest for tech enthusiasts, it is becoming integrated into mainstream finance, Gupta adds. Navigating risk and reward. Naturally, the journey with Bitcoin is not devoid of risks. The wealthy in India are acutely aware of this. So, how do they reconcile Bitcoin's potential for high returns with its notorious volatility? Patel explains that the affluent approach cryptocurrency with a prudent mindset. We generally observe that they allocate no more than 2 to 5% of their portfolios to digital assets, which reflects a solid understanding of the associated risks and volatility. This cautious allocation enables them to harness the potential benefits of cryptocurrencies while ensuring overall portfolio stability. Gupta from CoinDCX draws a comparison to the early days of the internet boom. Investors are becoming more selective, concentrating on high-conviction assets like Bitcoin, Ethereum, and key Layer 1 protocols, where the fundamentals are becoming clearer and institutional interest is intensifying. Many also engage trusted advisors and establish specialized teams within family offices to manage cryptocurrency investments securely. Himanshu Maradia, founder and chairman of SIFDAC, points out that Bitcoin's impressive returns are hard to overlook. With an astonishing nearly 70% compound annual growth rate, CAGR, over the past decade, Bitcoin is attracting HNIs who are in search of higher growth compared to gold's more conservative 6 to 8%. They view cryptocurrency as a high-risk, high-reward component, 5 to 8%, of their investment portfolio. This exposure is managed through family offices, professional fund managers, long-term investment horizons, and diversification across Bitcoin, Ethereum, stablecoins, and Web3 startups. Secure custody and regulated platforms help mitigate operational risks, he added. The next generation's influence. So, Who is igniting these discussions about cryptocurrency at the opulent dinner tables of India? It is the younger generation. Patel highlights that the heirs of wealthy families are often the first to bring up the topic. Being more technologically adept and receptive to new asset classes, they frequently initiate conversations about cryptocurrencies. Meridia adds, these next-gen heirs are driving the push for digital diversification. They are influencing the strategies of family offices, advocating for the inclusion of cryptocurrencies and other digital assets, and even integrating them into succession and estate planning. Old gold meets new coins. However, it is important to note that Bitcoin is not without its risks. Meridia cautions that its price can fluctuate dramatically, with annual variations being 4 times greater than those of gold. Additionally, India's flat 30% tax on cryptocurrency gains and a 1% tax deducted at source, TDS, can significantly impact profits. HNIs are addressing these challenges through careful position sizing, secure storage solutions, and professional assistance to avoid hacks or errors. Experts believe that Bitcoin will not replace gold but will coexist alongside it. Patel anticipates that Bitcoin will play a more significant role in India's wealth management strategies over the next 5 years as regulatory frameworks and digital infrastructure continue to evolve. As regulatory clarity improves and digital infrastructure develops, we expect a notable increase in allocations towards Bitcoin, particularly among younger HNIs and forward-thinking family offices who view it as the digital gold of the 21st century, he explained. Gupta concurs that while gold's emotional and cultural significance remains unparalleled in India, Bitcoin offers something novel. It is digital, scarce, and borderless. The goal is not to replace gold but to diversify beyond it, he asserts. Meridia envisions Bitcoin constituting 5 to 10% of HNI portfolios in the next decade, driven by younger investors and innovative products like Bitcoin ETFs. Ultimately, gold and Bitcoin are not adversaries, they are evolving into partners. One represents timeless value, while the other embodies cutting-edge innovation. Together, they illustrate how India's affluent are harmonizing traditional and modern approaches to wealth management, one digital coin at a time. Crypto adoption in 2025, trends, challenges and opportunities. Are we witnessing a crypto revolution, or is it just another fleeting trend? The question of whether crypto adoption is truly on the rise is one that has sparked much debate. This article delves into the current state of crypto adoption globally, examining the driving forces behind its growth and the challenges it faces. We'll explore how different regions are embracing digital assets, the role of large institutions and governments, and the real-world applications that are shaping the future of finance. What exactly is crypto adoption? Crypto adoption refers to the increasing integration of cryptocurrencies like Bitcoin, Solana, and USDT stablecoins into daily financial and digital activities. This includes using crypto for payments, investments, remittances, and accessing decentralized applications. Adoption isn't just about individuals, it also involves businesses accepting crypto, financial institutions offering related services, and governments exploring blockchain technology for public infrastructure. As more people and organizations engage with digital assets, these technologies become more deeply embedded in broader economic systems. Growth and adoption is typically fueled by regulatory clarity, user-friendly platforms, and a growing understanding of the benefits and risks associated with crypto. Key drivers of crypto adoption. Several factors are shaping the trajectory of crypto adoption worldwide. Economic conditions, regulatory frameworks, and access to digital infrastructure are critical determinants. In higher-income regions such as North America, institutional demand and regulated investment products are major drivers. Conversely, in emerging markets, adoption is often driven by the need for financial access and currency stability. For example, in sub-Saharan Africa, where many lack access to traditional banking, digital assets provide alternatives for saving, sending money, and doing business. Countries like Nigeria and Ethiopia are seeing a surge in stablecoin usage to combat inflation and address foreign exchange shortages. Financial inclusion through crypto. One of the most promising aspects of crypto adoption is its potential to enhance financial inclusion. Decentralized finance, DeFi, platforms are expanding access to credit and savings tools, reducing reliance on traditional banking systems. This is particularly beneficial in underserved areas. As adoption increases, crypto plays a vital role in enabling users to participate more fully in the global economy. Crypto as an inflation hedge. In economies experiencing rapid currency depreciation, crypto, especially Bitcoin, is increasingly viewed as a hedge against inflation. Unlike fiat currencies, which central banks can print at will, Bitcoin has a fixed supply, offering a degree of scarcity. This makes it an attractive option for those seeking to protect their purchasing power in environments of persistent inflation. Countries like Venezuela, where hyperinflation is a significant issue, have seen a notable increase in Bitcoin usage. Tokenization, transforming asset ownership. Tokenization, the process of representing real-world assets as digital tokens on a blockchain, is revolutionizing how we think about ownership and investment. This approach allows assets such as real estate, stocks, and commodities to be divided into tradable units, making them more accessible and liquid. Tokenization lowers barriers to entry by enabling fractional ownership and enhances transparency through on-chain record-keeping. Financial institutions are issuing tokenized bonds, and platforms are facilitating the trade of tokenized art and infrastructure, fundamentally changing how value is stored and transferred. Global trends in crypto adoption. According to Chainalysis's 2024 report on global crypto adoption, there are significant regional differences in how crypto is being adopted. In North America, institutional investors are the primary drivers, with the United States ranking fourth on the Global Crypto Adoption Index. The launch of spot Bitcoin exchange-traded products has boosted institutional interest. In Asia, grassroots adoption is high, particularly in India, Vietnam, and the Philippines, where retail users rely on digital assets for remittances, savings, and investments. In regions like Sub-Saharan Africa and Latin America, crypto is often seen as a tool for managing inflation and facilitating cross-border payments. The role of institutions and governments. The involvement of large institutions and governments is pivotal in shaping the future of crypto adoption. In the United States, legislation such as the Genius Act and the Clarity Act aims to create a defined regulatory environment for digital assets. However, the approach varies globally. In China, despite bans on crypto trading and mining, there is persistent interest in Bitcoin as an alternative to the stock and property markets. Many Chinese investors are using offshore platforms or informal channels to gain exposure to crypto. Challenges to widespread adoption. Despite growing interest, several barriers still hinder broader adoption. Market volatility remains a significant concern, with frequent price swings deterring risk-averse users and institutions. Security risks, including scams, hacks, and the loss of private keys, also pose challenges. Regulatory uncertainty across jurisdictions further complicates matters, creating confusion about compliance, taxation, and the legal status of digital assets. Volatility, a double-edged sword. The unpredictable nature of crypto prices is one of the biggest hurdles. While some investors view volatility as an opportunity, many users prioritize stability. Until the market matures and prices become more predictable, volatility will likely limit the broader use of crypto in everyday transactions. Security risks, navigating the digital Wild West. Securing crypto assets can be challenging, especially for newcomers. Users are often responsible for safeguarding their own wallets and private keys, increasing the risk of loss due to human error, phishing attacks, or technical vulnerabilities. The lack of consistent security standards across the industry adds to the uncertainty. Regulatory uncertainty, a call for clarity. Unclear or inconsistent regulations across jurisdictions continue to hinder mass adoption. Businesses struggle to launch compliant products, and users are unsure about legal protections and tax obligations. Regulatory clarity is essential for fostering innovation and encouraging institutional participation. Expert opinions on the future of crypto adoption. Many experts believe that regulatory clarity is key to unlocking the next phase of crypto adoption. Paul Grewal, Chief Legal Officer at Coinbase, has expressed optimism about the potential for comprehensive legislation by August. Alex Gladstein of the Human Rights Foundation highlights crypto's role in advancing global financial access and individual freedom, emphasizing its collaborative and decentralized nature. Real-life applications of crypto adoption. Crypto is already being used to solve practical problems. In June 2025, the U.S. Federal Housing Finance Agency directed Fannie Mae and Freddie Mac to consider crypto as a reserve asset in mortgage risk assessments. Gridless compute in Africa is using Bitcoin mining to support rural energy infrastructure, monetizing excess renewable energy to generate additional revenue for remote communities. Conclusion. From institutional finance to rural energy projects, crypto is making significant strides in 2025. Driven by concerns about inflation, efforts to promote financial inclusion, and growing interest in tokenized assets, crypto is evolving from a speculative asset into a functional part of the global economy. While challenges remain, practical use cases are emerging across sectors, pointing to a promising future. What do you think? Are we witnessing the dawn of a new era in finance, or is crypto just another bubble waiting to burst? Share your thoughts in the comments. Is India ready for a national Bitcoin reserve? Could India's future economic security hinge on digital gold? The provocative idea of creating a national Bitcoin reserve is igniting fierce debate, revealing deep divisions about the country's financial future. And here's where it gets controversial. Pradeep Bhandari, a prominent national spokesperson for India's ruling Bharatiya Janata Party, BJP, has thrust this concept into the spotlight. In a striking India Today editorial, he proposed establishing a strategic Bitcoin reserve, a bold suggestion given India's current lack of clear cryptocurrency regulations. What makes this timing fascinating? Bhandari points to global precedents like the United States' growing Bitcoin interests and Bhutan's state-backed mining operations as evidence of an accelerating digital finance revolution. India stands at a critical crossroads, Bhandari asserts. He envisions leveraging India's massive renewable energy infrastructure, particularly solar and hydropower, to potentially mine Bitcoin, arguing this could position India as a global digital finance leader while boosting economic resilience. But here's the catch: Bhutan's transformation from tourism-dependent economy to digital asset powerhouse serves as both inspiration and cautionary tale. Since 2021, Bhutan has quietly built a $1 billion Bitcoin reserve using hydropower, now funding public services while advancing sustainability goals. India possesses the renewable capacity to replicate this model, Bhandari contends, though scaling presents unique regulatory challenges. Industry experts immediately raised eyebrows. Sumit Gupta, co-founder of India's first crypto unicorn CoinDCX, notes the glaring obstacle. India currently maintains reserves in USD and gold, but lacks any policy roadmap or regulatory framework for crypto assets. The government itself admitted in late 2024 that comprehensive crypto guidelines have no fixed timeline. Yet by mid-2025, a promising shift emerged. India pledged to release a detailed discussion paper incorporating perspectives from heavyweight institutions like the IMF and Financial Stability Board. This is the painful reality check. India imposes arguably the world's harshest crypto taxation, a 30% flat tax with no loss offsets, 1% transaction deduction on sums above 10,000 Indian rupees, and 18% GST on trading fees. Raj Kapoor of India Blockchain Alliance lays it bare: we lack mining frameworks, custody laws, and treasury guidelines. The RBI openly prefers central bank digital currencies over private crypto. Meanwhile, BRICS nations and G20 counterparts like the US are racing ahead with their frameworks, with 3 US states already authorizing Bitcoin reserves. This isn't recklessness, Bhandari counters, but strategic hedging against economic uncertainty. The IMF's recent classification of Bitcoin as a capital asset adds urgency. But Rohan Sharan of Time Chain Labs delivers the knockout objection: a Bitcoin reserve fantasy ignores India's clear preference for its digital rupee. Real progress lies in stablecoin regulation. They're essentially digital prepaid instruments we already understand. So where does this leave us? The government's upcoming discussion paper could ignite unprecedented national dialogue. But consider this provocative angle: is India's crypto taxation deliberately stifling innovation to protect traditional finance? And could renewable-powered Bitcoin mining actually accelerate green energy adoption? The burning questions remain. Should India prioritize Bitcoin reserves over immediate stablecoin regulation? Could renewable energy mining become India's economic trump card? Are current policies protecting investors or hindering financial evolution? What's your take? Could digital assets truly stabilize India's economy, or is this premature speculation? Voice your perspective below.